Welcome back to this week's webinar. I'm Jason Yarusi. Today we are going to talk about why it is important to diversify within your passive investments. So again, I'm Jason Yarusi of Yarusi Holdings. We're a multifamily investment firm here in the Southeast. We have acquired over 2,000 units in the last 6 years. And today we're going to talk about passive investments, how you can look at passive investments and why diversification is key, and the pieces that you can target when you do focus on making sure that you are diversifying across different investments. So passive investing, today we're going to talk about just investing in multifamily real estate. Now you can do a number of different ways to diversify. You can diversify on sponsors, meaning that you find great sponsors that you align with the focus, you align with their goals. They have the same goal, whether it be their long-term view, their long-term vision, their investment criteria. However, you align with the sponsor, meaning that you find good sponsors, the ones that are finding the deal, packaging the deal, putting together the deal, and providing the opportunity to you as a passive investor. So you can diversify across different sponsors. The next is that you can diversify across markets. And this means that you can invest in various markets. So maybe you will focus on just the Southeast and you'll pick certain markets like Nashville or Little Rock or Atlanta or Miami, and you will have different investments targeted in different areas of the country. Now, why is this important? Well, there is going to be different push and pull factors in all these markets. There may be different growth. There may be different dynamics that could help or hurt a market. You could have one market being very exposed to potentially a natural disaster, some hurricane or big storm or tornado, which if all of your investments are there could potentially affect you. There could be other things that come in, new regulations or new legislation that vastly affect this market that were not foreseen in the past. You also then could focus on other markets where those markets may be having different drivers, right? So different economic drivers, different employment drivers that pull more to those markets. So diversifying across markets that you feel strongly against or feel strongly for gives you the best opportunity to really vary your opportunities and vary your investments to give you more exposure to potential opportunities for upside. The next would be focusing on different types of multifamily assets. Now, you could focus on just Class A, large Class A multifamily properties just built brand new that maybe have just a little bit of upside remaining. There could be different marketing strategies, different little things that you can do inside the units just to maybe add some different values, different income drivers that could be added. However, they may be more cash flow driven, but not have a long-term big profit at the end based on just the lack of upside potential that may be remaining on these properties. However, they're going to be more stabilized and more persistent in their return structure. And at the same time, you can look at other investments who may have more back-end profit potential, however, are going to be a bigger lift in the front side, meaning there's going to be a lot more potential for increasing revenue streams, potentially lowering expenses. However, there's going to be a need to add a lot of different, we'll say, things from dealing with capital expenditures, doing construction, dealing with deferred maintenance that will be needed to this property. So it will be a slower push out of the gates to potentially get cash flow, and you will have more of the risk allocation on the back end sale profit. So looking at these three things, the sponsors, the markets, and the property types, can give you the best opportunity to diversify across multifamily assets and put you in a good spot to have the best, we'll say, investment strategy going forward. Now, past that, you can also invest in different cycles, right? So you can invest in different, and we'll say cycles, terms of properties. Some of your investments may be a 3-year investment. Some of your properties may be a 5-year investment. Some of your properties may be a 10-year investment. And what this will lead for is that you can set up different investments that may capitalize or look to exit at different parts where that money can come back quicker, right? And then you'll have other ones that will be a longer term deals that you can have your money at work for longer. However, you will not have the opportunity to benefit from the profit up front. So looking at this, there's a lot of different ways you can diversify across markets, diversify across sponsors, properties, and terms. And if you look at this, ask yourself what's important to you, because that's first and foremost. So as a passive investor, if you come here and you speak with us at Yarusi Holdings, we are going to target and focus on what are your goals as a passive investor. Because ideally, we might be a great fit or we might not. However, getting that information and understanding what you're looking for can help us best identify which of our opportunities may be a great fit for you. So if you do want to talk to us, go over to Yarusi Holdings. You can learn more about our company, what we focus on, and we'd be happy to talk to you about you and your investment strategy. So again, I'm Jason Yarusi. This is your weekly webinar talking about passive income, how to diversify across multifamily assets. We'll see you next week.